So what is really going on with the market right now? It feels like this giant tug of war, doesn't it? You've got geopolitical fear pulling it down, hard. But then you've got this surprisingly strong economy pulling it right back up. The big question is, which one's going to win? Let's dive in and try to figure it out. All right, first up, let's talk about the big headline that's got everybody spooked. We're seeing some serious tension building between the US and Europe. And believe it or not, it's all about the potential sale of Greenland. Now, this isn't just some diplomatic spat. No way. This is a real conflict that's already hitting portfolios and, really shaking up investor confidence. And this quote, wow, this isn't just some random soundbite. It's like a bad echo from the past. When President Trump starts threatening new tariffs, it's a direct flashback to those really damaging trade wars back in 2025. And you better believe that's a memory that has investors bracing for another round of economic pain. So, how did the market react? Well, it was swift and it was brutal. On Tuesday, the S&P 500, one of the best barometers for the market, it just plunged 2.1%. And let's be clear, that's not a little dip. That is a dive. And it's pretty much all because of this one geopolitical issue. And that fear was absolutely contagious. The Dow Jones also took a tumble, dropping 1.8%. It's just investors reacting to all this heated rhetoric and the giant cloud of uncertainty that it's creating. And the pain was really widespread. I mean, even the tech sector, which has been flying high, took a massive hit. The Nasdaq dropped a pretty steep 2.4%. It just goes to show you, right? When global politics get this tense, pretty much nowhere in the market is safe. But the damage wasn't just in stocks. Oh no. This one issue sent ripples across the entire financial system. You had bond yields spiking up, the dollar dropped to a 2-week low, and for everyday folks, mortgage rates shot up past 6%. It's just a crazy reminder of how interconnected everything really is in our global economy. All right, so that's the big, kind of stormy picture. Let's zoom in a bit. How are individual companies actually dealing with all this? How are they weathering the storm? Are their earnings reports just full of bad news? Or are they maybe telling us something different? So let's take a look at Netflix. It's a really mixed bag. On one hand, things look amazing. Record revenue, a huge number of subscribers. But here's the thing about the market. It doesn't really care about what you did yesterday. It cares about what you're going to do tomorrow. And Netflix's forecast for the next quarter? Well, it was weaker than everyone hoped. And that is the key point. It's that future outlook that's really gotten investors spooked. And what was the result of that weak forecast? We'll take a look. A punishing 7.32% drop in pre-market trading. It's just a perfect example of how a shaky outlook can totally wipe out the good feelings from a strong quarter. I'll say it again. In this game, what's next is always more important than what just happened. But it is not all doom and gloom. Let's talk about a completely different story. A company called OKLO Inc. Bank of America just upgraded their stock to a buy, and for a really good reason. They just inked a massive deal with Meta to build a whole advanced nuclear campus. I mean, this is real, tangible proof that these huge, forward-thinking deals are still getting done. And this isn't some one-off, niche story either. We're talking about established giants too. Look at Johnson & Johnson. They didn't just beat their numbers, they actually raised their outlook for the whole year. That's a huge sign of confidence. It just goes to show, while some companies are hitting the brakes, others are hitting the gas. The market is definitely not a monolith. Okay, now we get to what might be the most important piece of this whole puzzle. While all the headlines are screaming about geopolitics and shaky earnings, there's this incredibly powerful, almost hidden force working in the background. And that force is the American consumer. So this is the big question, isn't it? I mean, with markets falling and all this fear in the air, you have to wonder, is a recession just inevitable? It's so easy to look at the headlines and think so, but hold on, because the data we're about to see might completely change your mind. Okay, here it is. This is the number that changes the entire conversation. $22 trillion. That is a record high cash pile that American consumers are sitting on right now. Seriously, this one number completely reframes the whole economic outlook. And let's be super clear about what this is. This isn't just wealth tied up in the stock market. We're talking about cold, hard cash. Money in checking accounts, savings accounts, money markets. And that number has just skyrocketed from what it was back in 2019. This is an absolutely unprecedented amount of financial firepower in the hands of regular households. Just look at this chart for a second, because it shows why right now is so different. Back in the 2008 crisis, American households lost a staggering $8 trillion in net worth. But during the 2020 crisis, it went up by $13.5 trillion. Think about that. It was the first recession in American history where households actually came out of it wealthier. That's a huge deal. So let's just quickly break down this foundation of strength. First, total U.S. household net worth, a record high. And this is so important. This isn't just a story about the rich. Most income groups are holding way more cash than they were in 2019, even after you adjust for inflation. And guess what? That cash is being put to work, fueling this incredible surge in retail sales. This right here is the economic bedrock that's pushing back against all that fear we talked about. Okay, so we've got this major conflict. Fear on one side, a super strong consumer on the other. So what do you do as an investor? How do you navigate this? Well, let's take a look at the playbook from the experts over at JP Morgan. All right, first, JP Morgan says you gotta be clear about the risks, and they are serious. We're talking about a potential military conflict, inflation rearing its ugly head again, small businesses struggling and causing unemployment, and even something they call AI fatigue, where investors just get tired of the tech hype. These are the real dangers to watch out for. But to balance out those risks, they have a pretty clear four-part strategy. They're saying, 1, stick with your core holdings in big tech. 2, get some exposure to global growth through things like airlines and retail. 3, make some specific bets overseas in places like China and Japan. And 4, hedge against currency issues with things like gold and silver. Basically, it's a strategy that says stay in the game, but be smart and prepared. So we end up right back where we started, with this fundamental conflict driving the market. On one side, you've got the very real, very emotional pull of political fear. And on the other, you have the hard data, the undeniable reality of consumer power. Whichever one of these forces wins out is probably going to define the market for the rest of the year. So the final question is, in this battle between fear and fundamentals, which force do you think will win?